Hi everybody, this is Ellman, the Blue Collar Investor, with today's covered call writing question of the day. And today's question comes from Paul, who thinks he's found a low-risk investment with a phenomenal 5-day return. Paul writes, Hi Alan, I hope you don't mind, but I want to run something by you to make sure I'm not missing anything. MLNX is on your approved list. It closed yesterday at 103.38 per share. The October 105 strike ended at $8 per share. So in theory, I could buy 100 shares at 103.38 and sell the 5-day 105 call option for $8. If the price of the stock goes up to 105, I would net a 9.3% 5-day return. If the stock declines, I'm essentially protected down to 95.38. And if the stock rises to above 105 by Friday midday, all of the time value disappears, and I could buy back the option for just the intrinsic value and sell the November strike. What am I missing here? Except an incredible opportunity. It almost sounds too good to be true. Well, Paul, one of the lessons that I've learned over the years is that when a trade seems too good to be true, it is in fact too good to be true. It doesn't really exist. So, that being said, let's take a look at the trade as you've described it in your question. You're going to purchase 100 shares of MLNX at 103.38 and then sell the out-of-the-money 105 strike for $8, generating an initial 5-day return of a phenomenal 7.7%. Now, as you stated, if MLNX moves up to 105 or higher, you generate an additional profit of share value of $1.62, giving you a total of $9.62 return, or 9.3% again for the 5-day return. And again, as you stated in your question accurately, the break-even is the price that you paid, 103.38, minus the premium generated from the sale of the option, and that becomes 95.38 as your break-even. Let's remember that number, 95.38, as the break-even. So the first thing that I would ask myself if I was looking at this trade is, why is the premium value so high? What makes an option buyer willing to pay $8 with 5 days remaining? In other words, the price of that stock would have to go up $8 from the 103 it's currently sitting at for that option buyer to even break even. So let's go to our formula now to see if we can make some sense of this. We know that the time value of an option premium, and in this case it's all time value because the strike price is out of the money, consists of the time to expiration, which is only 5 days in this case, plus the implied volatility of the stock, or what the market is anticipating the price movement of that stock to be in either direction. So in this case, because there's so little time to expiration, the time value consists almost entirely of implied volatility. The market is anticipating a large price movement prior to expiration, 4 p.m. Eastern Standard Time on expiration Friday. And the most likely event that would cause such a large price movement is an earnings report. Now, as you know, one of the rules in the BCI methodology is to never ever sell a covered call option when there's an upcoming earnings report prior to expiration of the contract. So, most likely that's the event. You could check the news, but the first thing I would check to see if there's an upcoming earnings report, and in fact, there was. So now that we said that, let's take a look at a chart of MLNX demonstrating what happened to that stock after the earnings report. Take a look at this chart now. in the screenshot in front of you. As you could see on the chart in that yellow shaded area, it shows you a huge gap down in price when earnings was announced. And what I did was I drew two lines on it showing you that the price dropped from slightly over $100 per share to slightly over $80 per share. $20 drop in price. So although the $8 does look quite tempting to generate, it really pales in comparison to the $20 drop in the price of the stock. So this once again shows the importance of avoiding earnings reports when it comes to covered call writing. So Paul, I do appreciate the question. I think the main takeaway from this question and this video is that there is no free lunch in stock and options trading. When you see a return that generates 7, 8, 9% in only 5 days, before you run and enter that trade, ask yourself, why is that premium value so high? Why is the market anticipating such a huge price movement in that stock? And are you willing to take the risk that that price movement will be in a favorable direction for you? Generally speaking, the answer should be no, it's not worth the risk. So, Paul, I thank you very, very much for the question. I'm glad anytime to talk about avoiding earnings reports because it's such an important part of our BCI methodology. So I do appreciate the question. And as always, thanks to all of you out there for listening to this video. I hope you found it helpful. So, as always, this is Alan Ellman, the Blue Collar Investor. Take care, everybody.